Many U.S. investors face a common challenge: finding flexible funding to keep their real estate projects moving. Business lines of credit real estate deals offer an adaptable way to access capital when opportunities arise. On Real Estate Capital and Growth USA, we explore how this financing approach fits within modern real estate investment practices. Today's video breaks down what business lines of credit are, how they differ from traditional loans, and how U.S. investors integrate them into property funding strategies. Understanding this foundation is essential before exploring how a business line of credit operates and why it has become a key component in the U.S. investment landscape. Before we dive in, let's check out the disclaimer. This video is for educational and informational purposes only. Always consult a professional before making any decisions. Now, let's take a closer look at what a business line of credit actually is, and how it functions in the U.S. market. What is a business line of credit? Business lines of credit real estate deals have become an essential concept in today's U.S. property market, offering flexibility to investors and entrepreneurs who want adaptable access to funds without rigid lending structures. In the United States, many real estate professionals rely on these revolving credit options to manage financial flow between transactions or projects without entering into long-term loan commitments. Understanding how this type of credit functions and how it differs from standard business loans is key to grasping its relevance in modern real estate funding. Let's begin by exploring its core definition and how it operates within U.S. financing practices. Definition and core function. A business line of credit is a revolving financial resource that provides companies or business entities in the United States with flexible access to working capital. Unlike a lump sum loan, which delivers funds once and requires fixed repayment over time, a business line of credit allows borrowers to draw only what they need and repay it as funds become available. This system enables continuous access to capital, supporting consistent financial management and project momentum. For real estate investors, this revolving structure means they can handle funding gaps between closings or property improvements while maintaining liquidity. Such flexibility is particularly valued in the U.S. property market, where timing and quick decision-making often determine investment success. Distinction from traditional loans. One of the most notable characteristics of business lines of credit real estate deals is their distinction from traditional term loans. While standard business loans in the United States are structured with fixed repayment schedules and long-term interest, a business line of credit offers revolving usage. Funds can be accessed multiple times without reapplying. This difference gives investors flexibility to address short-term property expenses or bridge financing needs. It does not serve as a guaranteed source of profit, but rather as a tool for managing timing and cash flow across different phases of real estate projects. U.S. institutions typically provide such lines for operational support, not speculative activity, which keeps them aligned with responsible business finance principles. Availability and use across the U.S. market. Across major U.S. cities, from New York and Chicago to Dallas and Los Angeles, business lines of credit are accessible through both banks and alternative lending institutions. These financial products are designed to meet various business needs, including maintaining liquidity during unpredictable market cycles or handling operational costs between property deals. For the real estate sector, accessibility and control are the primary advantages. Investors can use credit responsibly to support business continuity while maintaining autonomy over cash flow. This adaptability is one reason many U.S. professionals view business lines of credit as a stabilizing factor in real estate financing strategies rather than a speculative leverage. In summary, business lines of credit real estate deals represent a flexible, revolving funding option that enables U.S. businesses and investors to maintain financial fluidity. Unlike fixed loans, these credit lines provide ongoing access to capital, that can support operational efficiency and project continuity. They do not serve as financial advice or a guaranteed solution, but as part of a broader understanding of how funding structures support the real estate economy in the United States. Recognizing how this mechanism works helps investors grasp its role in shaping modern financing strategies and prepares us to see how these lines of credit connect directly to property transactions. The connection to real estate deals. In the world of business lines of credit, real estate deals in the U.S., timing can define success or delay opportunity. From Florida's coastal developments to the fast-moving Texas rental markets, investors rely on revolving business credit to stay financially agile. This approach helps them respond instantly to property opportunities without interrupting cash flow. Unlike fixed-term loans, a business line of credit adapts to real-world project timing, empowering professionals to act when deals appear, not after approvals clear. This flexibility introduces the core of today's focus: how credit access supports liquidity, construction phases, and portfolio growth across the U.S. market. Liquidity between deals. Many U.S. investors recognize that between buying and selling properties, liquidity gaps can slow progress. A business line of credit bridges these moments by offering reusable capital. Instead of waiting for property closings, professionals can quickly cover renovation costs, earnest money deposits, or inspection fees. This revolving structure supports continuous project movement, particularly in high-activity states such as California, Texas, and Florida, where competition is intense and timing matters. Maintaining momentum in competitive markets. In fast-moving metropolitan areas such as New York, Dallas, and Los Angeles, investors often juggle several negotiations at once. Access to revolving credit helps them maintain momentum while awaiting financing approval or property sale completion. This adaptability doesn't replace loans, rather, it complements long-term strategies by ensuring consistent operational flow. Within the broader U.S. real estate finance landscape, this approach reflects the growing emphasis on agility and capital efficiency, two concepts shaping modern investment behavior. Complementing other funding strategies. While traditional real estate financing like mortgages, bridge loans, and construction loans remain vital, a business line of credit offers a flexible layer in the financial toolkit. It allows investors to cover gaps without disrupting long-term financing plans. Many U.S. professionals now integrate it as part of a diversified capital structure, balancing security and adaptability. The strategy supports scalability, not by increasing debt recklessly, but by using credit strategically to support growth cycles. Business lines of credit in U.S. real estate illustrate how adaptability fuels consistent investment motion. They empower property professionals to bridge funding gaps, maintain cash flow, and sustain portfolio activity without replacing established financing. The emphasis is on understanding how liquidity tools support the timing, scale, and coordination of deals rather than promoting specific financial actions. This explanation remains highlighting how strategic credit access fits within professional property operations across the United States. The next section explores how investors qualify for business credit access in the U.S., focusing on the structure and documentation processes that make it possible. Common ways investors access these funds. Accessing a business line of credit for real estate investors in the USA often begins with understanding how institutions evaluate business activity and repayment patterns. In today's real estate environment, where liquidity and timing drive success, investors who approach credit applications with organized documentation often experience smoother approval processes. Across U.S. markets like Florida, Texas, and California, institutions commonly assess factors such as consistent revenue flow, business age, and operational stability before determining credit limits. Each lender uses its own model, but the general foundation is transparency, record keeping, and reliability. This section explains how U.S. investors typically prepare and qualify for business credit access, exploring what documents, patterns, and relationships contribute to approval. Okay, without delaying, let's now examine the structured process behind how these credit lines are obtained and integrated into real estate funding operations. Preparation and documentation. Most U.S. investors start by organizing financial statements, proof of business activity, and property-related revenue records. These materials demonstrate that the business operates sustainably, making it easier for institutions to assess repayment capability. Lenders generally look for clear revenue patterns, up-to-date tax documentation, and a formal business structure. This preparation step supports smoother access to business lines of credit for real estate projects USA, ensuring investors can demonstrate operational strength before requesting flexible capital. Evaluation and approval process. Once the application is submitted, most institutions perform a review of cash flow consistency, credit history, and business operations timeline. Instead of relying solely on collateral, many modern lenders focus on how the applicant manages recurring obligations and debt utilization. This approach aligns with a national trend emphasizing business credit responsibility in real estate financing USA, recognizing that professional management often outweighs traditional metrics. The process remains systematic, prioritizing clarity, accuracy, and communication between lender and investor. Integration into real estate operations. After approval, many investors in the U.S. real estate sector link their line of credit to dedicated business accounts used solely for project expenses. This structure simplifies cash tracking and supports clear reporting for multiple properties. By aligning revolving credit with ongoing expenses, such as renovation costs, marketing, or holding fees, investors maintain steady financial mobility without overextending commitments. This structured integration reflects modern real estate funding practices USA, where liquidity tools support professional-grade project execution. Accessing a business line of credit for real estate projects in the U.S. is largely about organization, transparency, and relationship building. It demonstrates how professional investors structure their financial operations to align with lending criteria rather than seeking shortcuts. This explanation remains educational and informational, offering insight into the typical evaluation process used in the United States, without providing individualized financial or legal direction. It illustrates how clarity and preparation open doors to funding solutions that sustain project momentum and long-term growth potential. In the next section, we'll explore how these credit lines are applied in real estate scenarios across the U.S. market. Typical applications in real estate scenarios. In U.S. real estate, timing and liquidity are critical, which is why business lines of credit real estate deals USA serve as a strategic tool for investors managing multiple property projects. They offer flexible access to funds that can be deployed when acquisitions arise, renovations are needed, or rental portfolios expand. Across high-demand markets like California, Texas, and Florida, investors often use these lines of credit to maintain operational fluidity between refinancing cycles or to support ongoing property upkeep while awaiting rental income. This approach allows professionals to leverage revolving credit effectively without committing to a full-term loan for each requirement. In the following section, we'll explore the most typical applications of business lines of credit in real U.S. real estate scenarios, revealing how professionals strategically allocate these funds to maximize operational efficiency. Funding property acquisitions. Business lines of credit in the U.S. often serve as a bridge for timely property acquisitions. When competitive offers appear, investors can quickly deploy funds to secure a property without waiting for conventional loan approvals. The revolving credit nature allows multiple projects to operate simultaneously, which is particularly valuable in fast-moving urban markets like Miami, Dallas, and Los Angeles. Supporting renovation and maintenance phases. Investors also use these credit lines to fund renovation projects and property improvements, ensuring that rental properties or resale units meet market standards. By tapping into flexible capital, U.S. professionals maintain property quality, schedule contractors efficiently, and avoid delays that could impact occupancy or market value. This approach is widely adopted in states with high rental demand and flipping activity, including Texas, Florida, and California, where well-timed improvements can significantly enhance portfolio performance without relying solely on traditional loans. Expanding rental portfolios. Beyond individual projects, business lines of credit enable U.S. investors to scale rental portfolios strategically. Capital can be drawn and redeployed to cover multiple units simultaneously, manage short-term cash flow gaps, and coordinate multiple acquisitions across regions. This strategy enhances operational agility without over-leveraging a single project. Business lines of credit in U.S. real estate provide a flexible, strategic tool that supports acquisitions, renovations, and portfolio growth without committing to full-term loans. They allow investors to maintain liquidity, respond to opportunities, and manage multiple projects efficiently. It illustrates how revolving credit integrates into professional property operations across the United States. Understanding these typical applications prepares investors to see how credit can complement overall capital management strategies. Insights from investor experiences. For many U.S. investors, business lines of credit real estate deals USA provide a versatile financial tool that adapts to changing market conditions. Whether bridging gaps between transactions or managing renovation cycles, revolving credit allows professionals to maintain operational continuity across diverse projects. In high-demand markets such as Arizona, North Carolina, and Florida, investors report that structured credit access reduces downtime between acquisitions, supports property maintenance, and improves flexibility in portfolio management. The consistency of this pattern underlines the importance of strategic cash flow control in the U.S. real estate sector. In this section, we explore practical examples and insights from U.S. investors, highlighting patterns of credit usage that illustrate its role in supporting operational efficiency and project continuity. Bridging expenses between projects. Investors in North Carolina often use business lines of credit to bridge expenses between acquisitions. For example, a mid-sized property management firm tapped a revolving line to cover interim costs between two multifamily acquisitions, ensuring that neither project experienced delays. This approach illustrates the flexible deployment of business lines of credit real estate deals USA, supporting liquidity without relying solely on conventional loan structures. Managing renovation timelines. In Arizona, investors report that access to revolving credit helps manage renovation timelines without project delays. When multiple upgrades are required, funds can be quickly reallocated to different sites, maintaining consistent project quality. U.S. investors highlight that this strategic liquidity allows them to coordinate contractors efficiently and avoid bottlenecks in property preparation. Flexibility across portfolios. Across various U.S. regions, revolving lines of credit support portfolio diversification and strategic investment. Investors can deploy funds to multiple properties at once, track spending, and maintain operational momentum. This pattern reinforces that adaptability and controlled cash flow are central to sustainable real estate growth, particularly in markets like California, Texas, and Florida, where multiple projects often overlap. Investor experiences consistently reveal that business lines of credit real estate deals USA are most effective when used strategically to maintain cash flow, bridge gaps between transactions, and coordinate renovations. By observing patterns across the U.S., it's evident that adaptability, organized fund management, and operational transparency define professional use of revolving credit in real estate. Understanding these examples prepares investors to recognize the practical utility of business lines of credit in real-world scenarios. In conclusion, business lines of credit in real estate serve as an adaptable resource for investors seeking operational flexibility and steady funding options. They fit within broader U.S. trends of balancing liquidity and long-term portfolio growth. For those exploring educational content on real estate funding structures, more videos on Real Estate Capital and Growth USA offer practical overviews of financing concepts and strategies shaping the U.S. market. Stay informed and subscribe to Real Estate Capital and Growth USA to keep learning from upcoming insights and analyses on real estate capital solutions. Thank you for watching.